Hey everybody, Bill Butler here. Thanks again for watching another edition of The Scoop, Melrose Scoop. I am here with a friend of mine and colleague, David Faraca of Independence Mortgage Group. And today we wanted to talk to you about interest rates and financing and what's ahead in 2017 for the housing market. David, thanks for joining us here. Thanks. A little stroll down Main Street here in Melrose.
Yeah, it's my first Facebook Live. Thanks for having me.
Anytime. So, wanted to kind of talk about, we know interest rates are going up. Tell us, kind of what you're seeing on the ground level.
Well, we certainly have seen a bump in rates since the election. We were as low as 3.5% on a 30-year fixed.
Right.
And then since the election, November 8th, rates steadily have climbed. The last 8 weeks straight up, we got as high as 4.25%. And what that means, to put it in relative terms, if you had a $300,000 mortgage, the difference would be about $100 a month. So it certainly affected the amount of property you can buy because of the increase. But the last week we've seen them come off a little bit, and we're back down to about 4% on a 30-year fix.
Okay, back down a little bit. All right, I'm going to try and extend this a little bit here.
And so what we're thinking in the remaining 2017, we're
let's take a ride over here.
Assuming, and the Fed has already talked about potentially 3 rate increases over the next 12 months.
Okay.
So certainly we're going to have some ups and downs, some up weeks, some down weeks, but the trend is definitely up. For 2017, and historically, again, we are still pretty low, but we're looking to be headed up.
Okay. Tell us, about kind of what down payments and any special programs that are out there with people who don't have 20% to put down.
Well, that's actually a good segment of the market right now. That the underwriting guidelines are easing up a little bit. We're seeing programs out there that allow you to put as little as 3% down, all of which can be a gift. So lenders are trying to get the millennial market, the first-time buyers, making it a little bit easier. Credit scores over the last several years, if anybody's refinanced or purchased, they know the paperwork and that's involved, and it can be overwhelming at times. But that's starting to ease up.
Yeah.
So I think 2017 will be a little bit easier to get a mortgage and certainly less of a down payment required.
Okay, and so some people I'm sure will be thinking, gosh, if all we need is 3% to put down and it can be a gift. Are we headed back to those crazy days of no doc and, hey, you got a pulse and we'll give you, $500 grand?
No, I don't think we'll ever come back to those days, the 100% financing, the no income verification. We got in a mess of trouble back in 2008. It all culminated. So I don't think we'll ever get to that spot again.
Yeah.
But in reaction to that, allowing 100% financing, no doc, we went the other way. Underwriters asked for more paperwork than you ever imagined. Everything blood work they're asking for people, and we realize that isn't doing anybody any good. We have to start easing credit scores and verifications, and so I think we're going to come into a 2017 that's a little more friendly for underwriters.
Yeah, I know, because usually in my buyer consults I talk to people and say, this loan process is nothing short of a federal investigation.
Oh, it's crazy. It's been crazy.
And, the pendulum swung so far one way back in 2004, 2005, and now it's swung back the other way, but it looks like the banks are a little bit more confident in kind of their due diligence efforts, and
absolutely
might make it a little bit more realistic.
Absolutely. It's going to be, it's still they're going to require the same W-2s, tax returns, pay stubs, things like that. But as I said, the credit scores, the amount of money down, self-employed borrowers, there's different programs. So some of the programs that sort of a hybrid of what they used to have are going to come back in and allow we're in one of the lowest home ownership times of our lives in the history of the country.
Yeah.
So that they want to spike that up a little bit and try to help first-time buyers get out there.
Yeah. What about you get a lot of refi apps right now, or a lot of people, or is that kind of gone away? Or
That's died down. Died down quite a bit. We had, a lot of people when they saw 3.25, actually under 3% on a 15-year fixed.
yeah,
We had a lot of people dropping from a 20-year, a 30-year down to a 15. But we've seen a little bit of a spike, and so the refinance. A lot of people have refinanced over the last 2 years, so we've seen that slow down a little bit.
okay, all right,
But the spring market's coming up, so we're anticipating a good purchase market this year. The inventory, as you know how it is,
yeah,
so we're hoping for a strong spring market.
yeah. If there's, speaking of refis, if anyone is watching, still is paying private mortgage insurance or PMI, there's a good chance. I mean, is that kind of an outdated loan?
Well, it depends. Depends. If you put 3% down a year and a half ago, you probably still need to have that mortgage insurance. But as you know, values have skyrocketed, especially in Melrose, all over the Boston area.
Yeah.
So if you put 10% down in 4 years ago, you have a very good chance of your property being well up over the required amount, allowing you to get out of that PMI.
Yeah.
So then there's several ways to do that. I basically tell people if they're in MI, take a look at their current rate and maybe make a call in regards to getting rid of that.
Seeing if they can kind of. It's definitely the values have gone up. I know a lot of my clients have refied out of it.
You could save you $400 a month. On a $400,000 mortgage, you put 10% down. You could save between $200 and $300 a month, $400 a month. It's a no-brainer. And there's other programs now that if you don't put 20% down, there's an LPMI, lender-paid mortgage insurance, or the conventional mortgage insurance. But there still are several ways to get into a property. And I've talked to you about it. People in the rental market is huge right now. The rents are higher than they've been in ever. We're at all-time highs on rents, and you see it's not uncommon to see $1,500 to $2,000 rentals. And when you can get into a $300,000 mortgage and pay about $1,500. So why not build equity for yourself and take advantage of the rates before they really start going up?
Yeah, yeah. Cool. Well, hey, man, thanks so much. Nice little beautiful walk today.
Yeah, nice little day.
In January here. Thanks, everyone, for watching. Have a great weekend, and we'll see you next week on The Scoop. Thank you so much, David Faraca.
Thank you, Bill.
All right. Take care. Bye.